Hello and welcome to the Financing a Sustainable Future podcast, brought to you by the Initiative in Sustainable Finance, funded by the Global School of Sustainability here at LSE. I'm Tom Gosling, Professor in Practice and Director of the Initiative. This is a podcast where we talk to LSE academics about their research on sustainable finance in a way that is accessible for practitioners. I'm delighted to be joined today by Martin Oehmke, Professor of Finance here at LSE, to discuss his paper, A Theory of Socially Responsible Investment, co-authored with Marcus Opp of the Stockholm School of Economics. And normally on this series we discuss working papers from LSE academics. This one has actually been published in the Review of Economic Studies in 2025. But the issues it addresses are so central to the Initiative in Sustainable Finance that, Martin, I wanted to have you back as our first repeat guest to discuss this paper. So thank you very much for joining.
It's a pleasure to be on your podcast again, Tom.
So I'd like to start off with your research question. You tackle a very fundamental question. So when, if ever, does socially responsible investing change real-world outcomes rather than just reshuffling who owns which assets? What motivated you to take this question on?
So this was actually the first paper I started working on and then wrote in this research agenda that Marcus Opp and I have that tackles issues in sustainable finance and in the connection. The last paper we talked about was green capital requirements, the connection to financial regulation or bank regulation. And we started, Marcus and I, my co-author, we started talking about that. In fact, in 2019, we're at this big American Finance Association, American Economic Association conference that happens every January. And Marcus and I had known each other for a long time. We finished our PhDs the same year, started as assistant professors in 2008. And over the years, we talked a lot, but mainly we're both big Bayern Munich fans. So we talked mainly or a lot about football. But then in 2019, we decided that this area was something where our background, coming more from the corporate finance theory side, could add some value. The background was we had both seen a paper by Oliver Hart and Luigi Zingales about stakeholder value. Should companies maximize shareholder value or stakeholder value at one of the NBER conferences? So we started discussing that paper and then thought that particularly on the corporate finance side, there was a lot of interesting stuff to be done. There was at the time already quite a bit of what I would call more asset pricing side research, which is, do particular stocks, you might label them sin stocks, have higher expected returns than other stocks. A lot of this was about pricing though. So we wanted to make the connection, this corporate finance connection, to the question of investment. We thought ultimately sustainable finance probably wants to change, or socially responsible finance as we call it. I sometimes like that term, slightly broader term, and that's what we put in the title of the paper. But what are the situations under which investors who think about these issues, who want to be socially responsible, can actually change what firms do? And for that you need some sort of, I think, corporate finance frameworks to start answering that question.
So just developing on that corporate finance theme a little bit, you build your setting at the firm level with a firm having a choice between clean and dirty technologies. Why do you think it's so important to build this bottom up at the firm level rather than the sort of top down asset pricing research, which we often see in this area?
It's a good question. I would say that's almost, even if we go outside of this particular research area, what, of course, in microeconomics, a lot of people have been doing for a long time, where the question is, or the approach is, to understand these phenomena, you want to think about how the ultimate decision makers, this could be households in other areas of economics or finance, or in this case, firms or the managers of firms or entrepreneurs, make their decisions whether to, say, in this case, use a more sustainable production technology or whether they will pollute. Of course, this is not something we invented. And in fact, in terms of background, maybe I'll mention that I think that will also, put in context what we're trying to do in this paper. What I think is the pioneering paper in that field that still comes more from an asset pricing perspective, but has a firm decision in it. That's a 2001 paper by Oehmke, Kraus and Zechner in the JFQA. I think ahead of that, ahead of its time in a way. And so that paper comes, I was saying early on, maybe more from an asset pricing perspective than we do. What do I mean by that? They essentially take, if you take a asset pricing course, the first foundational model you'll see usually is the capital asset pricing model. And so that's a world where assets, shares are trading, investors hold them, and it's a risk-sharing type of situation. In the end, in that model, everybody will hold the market portfolio, and then expected returns, or if you flip it around, the cost of capital for firms depend on, well, how much do they contribute to market risk? And so Oehmke, Cross, and Zechner had this idea to say, well, hang on, but what happens if there are some investors that do not want to own particular stocks? Could be that you're saying ExxonMobil or some other stock we're going to exclude from our portfolio. Of course, these shares that are being divested then by some people, they're not going to disappear. Somebody else has to buy them. And so in these types of models, it's a risk-sharing channel that can potentially induce firms to change their behavior. Essentially, those firms that now are no longer held by certain investors or maybe certain university endowments, other investors have to absorb those shares that are being sold. Those investors will say, well, but now we're holding proportionally more of those shares than we did before, so our risk sharing is not as good as it used to be, so we're going to ask for a higher return on those shares, which means the cost of capital for those firms has gone up. And coming back to your question about the decision, so one of the things Oehmke, Cross, Zechner already do in this paper, although more from this asset pricing side, is to say, well, suppose now firms could change from being within that blacklisted set to the set that everybody can invest in. And of course, or what they show is if this risk-sharing channel is strong enough, if their cost of capital has gone up enough, then they might choose to reform what they do.
And how does that relate to your model and what your model implies about the trade-offs faced by an entrepreneur deciding to invest? And then how, therefore, can a socially responsible fund induce a firm to switch technologies in your framework?
So the paper we just discussed by Oehmke, Cross, and Zechner, as I said, foundational, really important paper. At the same time, my view is that the channel described there is relatively indirect. As we were just discussing, it works through risk sharing is not as good as it used to be. Therefore, the cost of capital adjusts. And this, in fact, was a big question that came up. If you remember some of the discussions about divestment, one big example was South Africa during apartheid, but also it comes up at universities from time to time, right? When students say, should perhaps a university endowment divest from particular stocks? And of course, the counter argument that people make is to say, yes, of course they could divest, but as long as there are a sufficient number of people who are still willing to buy those stocks and who are well capitalized, most likely that effect on the cost of capital is quite small. And so that, in fact, coming back to the paper Marcus Opp and I wrote, was our motivation. We then asked ourselves, well, suppose we believe, and that is my view, that the risk-sharing channel, this kind of CAPM world channel, is modest in size or small. What else can socially responsible investors do, and how can they, even if we believe there's abundant, that's what we call it in the paper, abundant profit-seeking capital, is there still a way for socially responsible investors to change firm behavior? And the way, of course, we do it then in our paper is not because I believe the other channel isn't there, but then the cleanest way to think about that is to write a model where, in fact, this Oehmke, Cross, Zechner CAPM channel is absent. So we wrote a paper which is something that's much more common in the corporate finance theory literature than on the asset pricing side, where in fact we just assumed, suppose it's a risk neutral setting, so we're not thinking about risk premia here and diversification. We're switching off this divestment cost of capital channel. What can socially responsible investors do in that scenario? And so in that case, in fact, just saying, well, suppose we divest or just don't buy Brown or shares from polluting companies is not going to have an effect, because then on the other side, somebody else will say, well, if you don't hold them, we will buy those shares. prices don't change at all, and what the decisions that firms make will also not change. And that comes to you, I just mentioned a word to, I think, an important theme that runs through the paper that Marcus and I wrote, which is, if you're in that situation, then your role as a socially responsible investor, I think, becomes more complicated, but I think also more interesting. Because now you are in a world where you have to think about trade-offs. In other words, a story, say, which sometimes we hear or used to hear from the industry, you can do well by doing good. You can change firm behavior, but also get the same return that other investors who don't care about these things get. That's no longer going to be true, because everything that gives you, say, market returns, it could be a polluting technology or a non-polluting technology, but any change, say, from polluting to non-polluting, that's possible without any financial sacrifice, the profit-seeking investors will fund that. And so once you switch off this risk-sharing channel, there's really only one way for the impact investors, the socially responsible investors, to change behavior, which is they have to offer something that the profit-driven investors are not willing to offer. And that's a discount relative to the usual market returns, and otherwise subsidize firms in order to become more sustainable, to become cleaner, through the pricing of, say, credit that you give to those firms.
So they have to be concessional capital providers, in effect, accepting a lower return. But what you also kind of find is that not only must the responsible investors mandate kind of explicitly allow for this kind of concessional return, but they also need to trade off financial returns against reductions in externalities in total, right? Can you just expand on why is this the case? And what goes wrong if the fund only focuses on the sustainability characteristics of the firms in its portfolio rather than the sort of counterfactual impact?
Yeah. So this comes to, I think, the heart of our paper, which is to think about, suppose you have an impact fund, and that impact fund can have different types of mandates. And one mandate that a lot of people might immediately think about is something that in our paper we call a narrow mandate. What do we mean by narrow mandate? It's what you were just describing, Tom, which is that I'm going to look at my portfolio, and suppose I care about carbon emissions. I'm going to look at the carbon footprint of my portfolio. And if I think there are firms that have too high of a carbon footprint, I will not put them into my portfolio. And so we call that narrow because you're narrowly, in a way, looking at your portfolio and not the broader world out there. If you do that, this comes back to the discussion we had earlier on. If you do that in our setting, then, well, those firms that you no longer want to have in your portfolio, you can think of it as you're effectively divesting them. But because there are other people who will just snap up those shares, buy them, nothing will change. The pricing of, say, the credit that those firms issue will not change. And so there's no impact from saying, I would like to reduce the carbon footprint of my portfolio. You have to, and I think that's, as I said earlier on, really the core of the paper. In our framework, the socially responsible investor, the impact fund, has to think more broadly about the world, if you want. We call it a broad mandate or an impact mandate, where the thought process you go through is to ask yourself, suppose we don't invest in a particular company. What would happen? What technology would they choose? How much would they pollute? Would they be running sweatshops? Would there be child labor? Whichever externality you might think about. And then you ask yourself, but if we do invest, can we change that behavior? And it's about that counterfactual. So you are thinking about what would happen if just the profit-seeking, profit-maximizing investors were in that firm, and what would that firm look like with your, if you want, catalytic investment that you're going to put in there. And that's what you're trading off. You mentioned this trade-off. without any sacrifice in returns, you will not change what the firm does. So the thought process of the impact fund here is, well, how much am I getting in terms of reduction of externalities, reduction of, say, carbon emissions relative to the concession that I have to give to the firm? And that's ultimately something that impact investors then have to think about, I think, quite hard when they develop the mandate of their fund. How much do you care about externality reduction relative to your returns? And so this is in the model just a parameter, how much the fund cares about these things. But in practice, this is, I think, an important discussion. Of course, there's a big discussion, as you know, currently about issues related to fiduciary duty and how strictly should that be tied just to a risk-return trade-off, or simplifying it a little bit, profit maximization, or how many other aspects are you able to put into your mandate while still being under your fiduciary duty.
And in your model, you identify two ways in which this impact can arise within the firm. So one is as a switch in technology, but the other is as a scaling up of clean production. Can you just talk through the resulting kind of complementarity you find, which I think is really interesting, between socially responsible capital and profit-seeking capital in order to maximize impact?
Let me just take a step back, because I think it's also perhaps interesting for listeners just to, I don't know, hear some of the backstory. Or, you know, when I work on these types of applied theory models, of course, there are always some results that I'm looking for. You know, you have an intuition, you build a model, you have an intuition ahead of time, and hopefully the model will be in line to some extent with the results that you're expecting. But a paper that only has, say, expected results can be a somewhat boring paper. It could still be important to write it, but usually I think I'm looking for something where you say, oh, I captured some of the first order elements I wanted to capture, and then there's also something else I learned from the model. And so you mentioned that in this model, one of the things that can happen is that there is a complementarity between the profit maximizing investors and the impact fund or impact investors. And that's something that was not something we had in mind when we started writing the model. That's something that dropped out, and we thought that's actually very interesting. And you know, then you ask yourself, well, let us see if this is just some artifact of the model and maybe it's second order and not that important, or is it really something where we learn something about the real world? Now, in this case, I think we do learn something, and I'll maybe try to give an example highlighting what happens in the model, which is, you know, if I think more generally about how much are we willing, in this case, the impact fund, to make sacrifices. Of course, it depends on what's going to happen if we don't engage, if we don't do anything. And the complementarity that you mentioned says that in our model, it can be good to have both the impact fund and also the profit maximizing investors. And one force that's driving that is that the counterfactual, what happens if we don't invest, of course, is worse from the perspective of the impact investors if there are these profit maximizing investors that would cause pollution externalities. And so and of course we don't want them to do that, so hopefully in the end they will not. But what it does is it incentivizes the impact investor to go in more forcefully, if you want. And this actually relates to another, I think, important aspect of our model, which is the impact investor, and we can talk about that more. Of course, because they think about changing outcomes, we should think of them as a large investor. Because small investors, they essentially take aggregate pollution as given, because they realize I drive my car just a little bit less, it's not going to have an impact. Okay. So here we're thinking about a large impact fund. This could be a sovereign wealth fund, but it could also be a private fund, but large enough so that they know by investing in certain companies, they can change what those companies do. But once you move to large actors, large funds in this case, or large firms, say in I/O models, they usually also have market power. They will not compete as forcefully as a lot of small investors that are seeking the same opportunity. And so the complementarity, coming back to it, that you mentioned, has a little bit of that flavor, that the presence of the competitive financial investors induces the large impact funds to also behave more competitively. And the right combination then, at some point in the paper, we call this, if you want, the balance of capital. The right combination you would like is have sufficient socially responsible capital so that firms choose the right production technology, in this case, in our wording that we use the clean technology, but at the same time have some of the competitive financial investors to make sure that the large impact funds behave competitively. And so you essentially, the threat, make sure that they don't act like large players with market power. And that's a result, coming back to where I started, that when we started writing down the model, it was not something we had thought about, but something that the model delivered. And I think it, to me, intuitively makes sense that, of course, if we were in a world where there's only one or maybe two large impact funds and that's it, that maybe those funds would have too much market power, and so that having some of these profit-seeking investors to discipline them to not exert that market power is a good thing, and hence having both can be the right outcome in our model.
And I'd like to come back to those people who do invest in the fund, because given that socially responsible funds need to accept financial trade-offs in your model, this raises a question about how they can raise enough capital to become viable, because if investors are only prepared to invest in these funds if they have impact, but then they need to have scale to have impact, then you have a classic sort of free rider problem, and it may be that these funds just sort of never get to the scale where they need to be effective. So what's the solution to that? You discuss non-consequentialist preferences as a possible solution to the free rider problem. So how do you see that playing out? How important are those preferences in sustaining socially responsible funds? And does this imply that there are some limits to how far private capital can solve these problems?
That's a really interesting question. So you mentioned the words consequentialist, non-consequentialist. So what does it mean in our paper? We were talking earlier on about the impact fund in our paper, and if that impact fund thinks kind of broadly about the world, they will internalize this counterfactual or the reduction relative to counterfactual in externalities that they can hopefully affect. And that, of course, and we mentioned it earlier, means that they have to be and think like a big investor. And big investors, because, or another way to say it, because, and you mentioned that only big investors really internalize these consequences. So if you are a small investor, me and you, we think differently, right? We would say, well, okay, we might realize there are some externalities, but if I have to fly to Frankfurt tomorrow, I might say, well, that causes some emissions, but in the bigger scheme of things, the fact that I am that one additional passenger on that plane is not going to affect how much the airline industry is emitting. And so you have this typical, you mentioned the word, what economists call free rider problem, right? Where we all think that we're not affecting aggregate outcomes. We're each relying on the other person to make the sacrifice. Typical problem in public goods provision in economics, right? Everybody will benefit from an additional playground or public park that's being built. But if we're all small and we take the provision of those amenities as given, we're going to rely on everybody else to pay for them. And so this then leads to this question of, well, this big impact fund that I've been describing earlier on, and I've talked about how they can change outcomes and maybe how they might be trading off through their mandate profits or reduction in profits versus reduction in externalities. Where does it come from, right? How do they raise? Okay. There are two answers. I'm going to give you the shorter one first, but because it is, I think, in practice important, government is one answer. Meaning that, and I'll say that first because we just mentioned, say, the Norwegian example. Because, of course, governments might have revenues. They could be tax revenues. They could be revenues from, say, natural resources, as in Norway's case. And then you have a choice. You could say, well, we could just rebate this all to citizens, taxpayers, right? And then they can do whatever they would like. And maybe with some libertarian view, you might say, well, maybe that's what we should do, because then people can decide for themselves what to do with that money. But of course, once you do that, anything that's subject to a free rider problem, citizens individually likely will not invest in. And so one way I think of what a big government, say the Norwegian fund, are doing is to realize that, well, there is a free rider problem. There's public good provision. There are issues with free rider problems in reducing externalities. So actually, collectively, perhaps the citizens would like to reduce emissions, but if I rebate the money to them individually, free rider problem is there. It's not going to happen. So you prevent the free rider problem by investing as a large player, in this case the government fund, rather than rebating this. This idea has come up in other contexts too. There are papers that have also talked about this in the context of, say, companies that care about public goods. Should they pay out their earnings as dividends, or should they maybe use some of that to invest in public goods? And you can make a similar argument that if companies care about public goods, what would be a good example? Maybe they want the nursery, they want to fund it, because otherwise there would be a free rider problem if they... The second setting would be one, now stepping away from governments, where we're thinking about a private solution. Me and you, after this podcast, we set up an impact fund, right? And then we're going to try to raise capital. We go around LSE here and ask our colleagues, and they might say, well, given there's a free rider problem, maybe knock next door and maybe they will invest, but I won't. And so we might have a hard time if our pitch is reduction, you are kind of personally with your investment reducing externalities. So if the small investor, this is kind of the typical issue, and this is the tension that I find very interesting in this paper. The consequentialist view is very important for the large fund. Right, we talked about just looking at your own portfolio is not going to cut it in this model. You have to have this consequentialist view relative to counterfactual. You are changing things, but that makes it hard to get money from small investors. Okay, and so here then, rather than relying on this consequentialist thinking, a non-consequentialist type of thinking can be helpful. In economics, we sometimes call that warm glow, but I actually like the term non-consequentialist that you used, which is that our pitch to the people we're trying to get the money from is not that they are directly reducing these externalities, because they might say, well, the £100 that we're going to put in is not going to really make a difference. But you tell them, by doing this, by investing in this impact fund, which will then reduce externalities, you are doing the right thing. It's kind of like more of a moral, you are doing the right thing, kind of warm glow. And this discussion about, this comes to, I think, a question that still is at the core of, particularly once trade-offs are involved, at the core of this whole literature is, well, what's the motivation for individual investors, and how do these aspects of social responsibility, of sustainability enter their preferences, their utility function, right? And so what our paper points out here is that even though the large investors, you want them to be consequentialist, for them to raise money, it actually can be helpful for the small investors, me and you, to think about doing the right thing as opposed to non-consequentialist. rather than applying already in the first step as a small investor the consequentialist thinking. Because once you say non-consequentialist or warm glow, the question is, well, what is it that people feel good about? Mm-hmm. And so what's not going to work, this comes back to something we discussed at the very beginning, is to get a warm glow from only having clean companies in your portfolio, right? Then we're back to square one, where the other investors who don't care, they buy those shares and nothing will change. So it's a specific type of non-consequentialist or warm glow thinking that helps in our setting, which is receiving utility, a warm glow, a kick from investing in the impact fund, investing in a fund, and knowing that impact fund is not necessarily a fund that's only going to have non-emitting companies, right? Because as we discussed before, that fund might invest actually in some companies that at an absolute level emit a significant amount, but if the reduction you can get is large enough, that's actually where those capital should go. That's where you're going to have the biggest, according to our social profitability index, the biggest bang for buck as a sustainable or socially responsible investor.
So you almost need the non-consequentialist investors to get the warm glow from contributing to the potential of something good happening, even though it kind of might not and it's very vague, but they sort of provide the scale to enable the consequentialist investors to then go to work and do their thing. It's a very interesting complementarity, or have I completely mangled that?
Yeah, but I mean, the way you put it is exactly right. You need this non-consequentialist element at the level of the small individual investor in order to facilitate the larger consequentialist fund that then is able to actually induce the, say, reduction in emissions or whichever externality we're thinking about.
Very, very interesting. So I'd like to go back to one of your earlier assumptions, which was this one about profit-seeking capital being abundant. And so you drew this sharp distinction between divestment-based strategies and investment and impact investment in your paper. And I think probably most people would agree that the impact of divestment on cost of capital is at best small, but there's a debate about whether it's effectively zero or it's just a small positive amount. So if there was a modest cost of capital effect from divestment type strategies, would that create a qualitative change in your results or just an incremental change? What might happen?
I don't think it would change the paper qualitatively, and in fact, coming back to what we were discussing at the beginning, of course, my view is not that effect is literally zero. It's more like you were saying, that it's probably there, but small. And so then in terms of, let's say, clarity of the paper that Marcus and I wrote, we took a slightly more extreme step saying, let's just assume, to highlight the channel that we care about, that it's zero. My view in practice is that it's probably there, but modest. And you could, say, combine the framework that we've written with those kind of risk-sharing elements. And what it would mean is that there would be an additional modest channel from divestment, from caring about the carbon footprint of your portfolio. So rather than saying, look, that has no effect, the message would be that has an effect, but it's likely small. And so rather than, our model right now says without sacrificing return, you don't get anything done. I think the message, if we were to include also the cost of capital channel through a reduction in risk sharing, would be there is a small amount you can do without sacrificing returns, but it's not going to get you very far or far enough.
So just to close off, if there's one sort of common misconception about sustainable investing that you're hoping to sort of address or highlight with this paper, what would it be?
It would be doing well and doing good. I think while that was at some point perhaps a good marketing slogan for the financial industry, I think it masks the much more complicated reality of say, socially responsible investing, and that a lot of times, if you really want to change outcomes, there are probably trade-offs involved. And so the abstracting, from all the modeling details, if you ask me what would I like down the road, what would I like the impact of this paper to be, right? If I think in a consequentialist way, what should the impact of that paper be? If a few years down the road, because of this paper, the industry and people have started thinking more about this trade-off and what it means and how we should as a society be trading off sacrificing financial returns against the benefits from reducing externality. I think that's the key thing to take away, and I think it's important for all of us to just be honest and open about these trade-offs, because I think if we're not, it's going to be much harder to find a way to solve pressing issues such as climate change, but also other externalities we mentioned earlier on, maybe sweatshops, child labor. We have to be upfront and open about that sometimes dealing with these issues will not be something that comes for free, but as a society we might still want to deal with these issues, even though financially there is a cost.
I think that's a great way to sum up, Martin. Really enjoyed the discussion. I think your paper sheds real light on some of the often oversimplified topic of sustainable investing. So it was great to discuss with you again. Thanks very much for coming on the podcast.
As always, it's been a pleasure, Tom.
You've been listening to the Financing a Sustainable Future podcast with me, Tom Gosling. If you enjoyed the conversation, please like, share and subscribe on your favourite platform. To find out more about the work of the Initiative in Sustainable Finance, which is funded by the Global School of Sustainability here at LSE, please go to fmg.ac.uk/ISF.